It is a pleasure to have Mark Selby, CEO of Canada Nickel, joining Grizzle. He's got some big news for us, a feasibility study for the company. Mark, how are you? Nice to have you.
Oh no, great to be here and great to be here the day after hitting this big milestone.
For sure. Scott, you can kick it off.
Yeah, so Mark, my first question is, so you're in the process of building the second largest nickel project in the world. Why Canada and why now?
Yeah, so the key piece here, the biggest challenge to the nickel market is the 100% of the supply growth. More than 100% of the supply growth has basically come from high carbon, high environmental impact Chinese controlled operations in Indonesia. What the world needs nickel for the energy transition and for its existing uses is large scale, low carbon sources of nickel. And so, what we have just outside Timmins is going to be one of the world's largest nickel sulfide operations when it's up and going, over 48,000 tons of nickel a year over a 27-year mine life. Most importantly, it's hosted in rocks that have this great property that it spontaneously absorbs CO2. We designed a process where we inject high strength CO2 in, so we'll be able to capture and store over 1.5 million tons of CO2 per year, which would make us one of the largest carbon storage facilities in Canada and North America. So, Canada's got big goals in terms of reducing our carbon footprint and being a big producer of critical minerals. And our Crawford project and what we have in our entire Timmins Nickel District, is really taking a big step toward making those happen.
And Mark, just on that, with respect to the value chain and the importance of that, the carbon intensity of your nickel, could you maybe just give a quick high level on just the importance for manufacturers all the way down to the mining of nickel, of how we're seeing the importance of onshoring in North America, and again just away from high carbon sources, say from Indonesia.
Yeah, no, the entire, Inflation Reduction Act in the U.S. is about spending, tens of billions of dollars, to help do the onshoring that's there and get China out of supply chains for critical minerals. And so, what we've got in terms of being a producer of nickel, cobalt, palladium, platinum, and then iron and chromium also will be the only North American producer of that metal in Canada and the United States, where it's both a critical mineral. This Crawford coming along, we're really the only project of large scale that can come online before 2030. So, the governments want this to happen. Customers and industry want this to happen. And so, we're in great position. And it's the reason the battery supply chain guys and a bunch of the, auto manufacturers are banging on our door, wondering when they're going to be able to get part of the offtake for our nickel.
Great. Now, I wanted to move to the bankable feasibility study. Can you just kind of sum it up? What are the key improvements that came from yesterday's bankable feasibility study?
Yeah, so number one is just in terms of the scale of what we're mining in the PEA. We mine 900 million tons of material for a 25-year mine life. With the feasibility study, we start up at a much, basically 50% higher scale and have a 41-year mine life. And we'll be mining 1.7 billion tons, so we have a reserve of 1.7 billion tons, which will be the second largest reserve in the world. We made a number of improvements on the recovery side, 4% in total, but most importantly, we pulled a bunch of lower grade material in that we're now able to mine because we made recovery improvements. But if you look at the PEA versus the feasibility study, we improved our recovery by 9 percentage points, from 37% to 46%. It's a 25% improvement in nickel recovery. We improved our iron recovery by 50%. Again, this is 4 years from the fifth drill hole. Most companies take 8 to 10 years, to get to a similar point. So again, very proud of our team, to be able to deliver those kinds of results in a very short period of time.
Now, what really stuck out to me is that you're expecting this to be one of the lowest cost, if not the lowest cost, nickel project in the world. I'm just wondering, what are the main drivers of why the costs are so low at Crawford?
Yeah, so number one, in terms of, if you look at just the costs straight up as a nickel operation, again, it's lower grade, it's lower recovery. People sometimes look at that and wonder why that works. All we're doing is taking the same scale that you would see a large scale, low grade copper mine and applying it to a low grade nickel deposit. We're in a place where we have grid electricity available. We'll have workers who will be able to drive home every night. And we'll have a highway and rail connection to the rest of the world. So we're not in some remote fly in, fly out location. all of those things help make a structurally lower cost operation. And then when you look at the first quartile of the cash cost curve in the nickel business, basically all those operations have substantial byproduct credits associated with them. So we have some cobalt, palladium, and platinum that come along with the nickel and the nickel concentrate. But the big driver of the additional value is the iron and chromium that we'll be producing. And so, again, not typical. It's the nature of the mineralogy and these ultramafic deposits that we do end up with this particular product. But fundamentally, North America use iron, chrome, and nickel to make stainless steel. One of the consultants we work with, there's over 1 million tons of stainless melt capacity that needs to be built in North America. There's a real market opportunity there. And then we look globally, there are, steel companies bending over backwards to find a way to make a zero carbon steel product. Well, guess what? We'll have, more than 1.5 million tons of iron, with 75,000 tons of chrome, which make us 15% of global supply, sitting in a location where you could build a steel mill. We can take all the CO2 that's generated by that mill and store it in our tailings. So, there's a real zero carbon melt shop opportunity, and we are having those discussions with stainless steel and ferroalloy players globally. So, and if anything, there's upside from the numbers that we've got in there in terms of the value of that iron chrome product.
And for me, it's been exciting, the ability of your rocks to store carbon, and that whole plan. You mentioned that a few minutes ago. But I wanted to ask, what are kind of the global implications, you think, if you're successful in building what could be a carbon negative nickel project? Now, my question is, would that be the first one of its kind? And do you think does that set a precedent where kind of mines in the future feel pressured to do something similar to what Canada Nickel's doing?
Oh, I think for Western miners, the fact that there's a whole group of mines like ours, a handful that have the potential to be able to do it, and again, right now the world, a few years ago the world was in this place. Well, we're going to have to hold our nose and take this really high carbon nickel from Indonesia because it's really the only alternative out there. What we're offering with Crawford and our Timmins Nickel District, and again, we think there's a half a dozen Crawfords, based on the exploration potential, that we see there. So we really can be a large scale, multi-mine, region to provide lots of low carbon nickel, that the market is desperate to see. So, I think, in terms of the pressure, I think it'll be, the pressure from consumers once they see what we've got, to be able to get to see more of that sooner, right? So, and again, the government's been a great partner so far. Our permitting process has been moving along quite nicely, and so again, the only roadblock we see is the capital required to unlock the potential that we've got in place in the nickel district.
So Mark, just on that, it's kind of, so you have this aspect of being first quartile in cash cost. That's irrespective of carbon capture, right? Like it just almost adds another layer of sellability, if you will, right? Is that a fair take?
For sure. There's a small amount of revenue from the carbon storage fees that we had a consulting firm figure out what would be a conservative market view of that, and we've got included $25 a ton in the feasibility study. We haven't included the fact that in 8 years there should be low carbon premiums available for low carbon product. That's not in there. The big plus for us right now is this carbon capture and storage refundable tax credit that the government's put forward. When you take the critical minerals credit and then take the carbon capture and storage credit, which we have to apply for, there's still we're 95% sure we'll get that, but that combined is over $1 billion US of tax credit money, which again really helps drive the overall economics. It also takes our initial capex of 1.9 billion, because with the carbon capture credit included, that actually takes that peak investment not only for the first phase but for the first and second phase down to $1.7 billion, because we get some initial production for a few years before we have to build the second phase, and then we get basically a whole stream of tax credits back as we build out the mining operation. So it's pretty amazing that you can get a $3.5 billion operation built for only $1.7 billion of upfront capital.
Now, can I talk about the capital a little bit? Because yesterday in your kind of update call, you gave a great overview, I think, of your plans to fund that 1.7. Could you kind of walk us through the split between equity and debt, and of the equity component, where do you expect kind of the money to come from there?
Yeah, no, I mean, again, people are looking at this saying, okay, it's effectively close to a $2 billion project. How is a 200 million market cap company going to, fund that? We're in this wonderful, 5 to 7 year window here where, it really is possible for two big reasons. Number one, so of that $2 billion, we'll need about $800 million of equity capital. The rest will be debt. When you look at the government funding, so again, with both credits in place, you've got several $100 million right up front from those two basically automatic programs. The federal government has the Strategic Innovation Fund. They have a Critical Minerals Infrastructure Fund. The U.S. Department of Defense, has another fund that can provide equity capital to projects anywhere in North America, and there's a new fund just emerging in Europe that'll have a similar vehicle. So, I will be disappointed if we can't get at least half of that equity capital, if not more, from that government funding right now that wants nickel projects to get built, in this side of the world. Then, the other big driver is the fact, you've got the car makers and the battery supply chain desperate to get, nickel in North America that they can supply to North American consumers. And so, again, if you had a copper project, you're not going to get an offtake partner who's going to provide lots of capital up front to make that happen. We've already seen it in the lithium space. We are having those conversations with the OEMs and the battery supply chain to see that capital come up front. So between the government, between capital that comes up front from the offtake partners, and then we'll probably stream some of our PGMs that are there, we can construct a stack where we don't have to come back to the equity market, to raise any more capital. So, it's a very, very doable capital stack.
That's very helpful. Now, Mark, maybe just to end off the interview, could I ask you what the permitting milestones are that remain, and kind of your timeline for when you receive the permits and then when you can make the all-important construction decision?
Yeah, so throughout this project, we've done things on a parallel basis. That's why we got to a feasibility study in 4 years versus 8 to 10 that a mining company typically does from beginning. We started the permitting process, back in July 22. We've already completed the first of the 3 stages in the federal permitting process. We'll complete the second stage of that in mid-2024. That puts the government on a clock of 365 days to come back by mid-2025 with a final decision. We expect they've made a lot of noises about trying to shorten the process, and we think there's an opportunity that we may even get our permits sooner than that. So that's key piece number one. Key piece number two is the financing package. So on the equity side, we're working with Scotiabank and Deutsche Bank, and again, they don't typically work with a lot of $200 million companies, so should sort of give some highlight in terms of what the opportunity is here. And then we've got our debt advisors with Cutfield Freeman. The goal here is to get our project financing package in place before year end next year. If those permits show up, we're ready to go. And so, right now our target is to have everything we need to be able to make a construction decision in mid-2025. It's a 30-month build, and so we're targeting first production, before the end of 2027. Most other projects of a similar scale can't come to market before, until the 2030s.
Great.
Mark, always a pleasure. Professor Nickel, as we like to call Mark Selby, Canada Nickel. Mark, a very exciting milestone. We're looking forward to watching the story evolve. We're shareholders in the DARP ETF. We're very thankful for you to join us. Thank you, Mark.
No, thanks for the opportunity, guys.